Welcome back. You're watching Stock Watch with me, Zinati Guma, and join me to unpack your stock-related questions tonight are Mutooni from Sanlam Investments and Rowan Williams from Nitrogen Fund Managers. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, gents. Quite interesting moves that we saw there on the JSE, particularly with resources, because we saw the PGMs kind of trading slightly in the greed, but then you saw Northern Platinum being one of the biggest gainers there. But the gold counters were down today, especially Goldfields. Roy, I want to start off with you. Goldfields, was this a case of the operational update, disappointing, or was it just, negative sentiment on gold today?
Hi, Zinati. I think it's a combination of both. I think the operational update wasn't particularly positive from a production perspective. And then also the sentiment around gold shares has definitely dimmed in the past few days, and you've seen them sell off. The gold price is high, but it's held up there. Remember, these shares tend to trade at a discount to gold. So I think a lot of the speculation took it all up. Operations reality comes in and gold price reality came in as well. And also we've got a slightly stronger rand, which has actually held up quite well for the past week. So I think it's a combination of all of that.
Yeah. And also, Rowan, is this also a case because, of course, when you look at the gold miners, you have to look at the gold price. Do they multiply whatever is going on gold? Whether if gold is under pressure, then they're heavily under pressure, and if gold's high, then they're really high?
Yeah, so certainly share prices are discounting future projections of cash flows, and obviously the key input for gold mines is obviously the rand gold price, as Roy's pointing out. So I think what we saw was sort of heightened geopolitical tensions about 2 weeks ago. People were getting really excited. And the sort of higher for longer narrative on the rates. Now we've had a new data print. The jobs figures on Friday were lower than anticipated. So now a rate cut in September is back in play. So that combined, as I said, with not escalating geopolitical tensions. We've seen the oil price come down as well.
Yeah.
And so these sort of safe havens have come down, and so they are very geared, the share prices, to the gold price, and I guess just an operational update reminds investors of that operational gearing, converting the operations into profits. So all combined, seeing quite a big sell-off on the day.
Yeah, because I was just about to ask if this is maybe not a wake-up call that as much as you may want to play gold, that the miners, there is that risk of the environment, the operational environment. So, Roy, I mean, just when you're looking at playing gold, where would you be going at this point?
So I guess there's like 3 or 4 levels which you could play. You could play bullion, I guess, Kruger rands, and hold them in your pocket. And you see those have a storage cost and they're tradable to a certain extent. You could play the ETF, which is pure gold as well. And that's a financial instrument. So you hold the paper, or you could hold or now you could hold the shares. The thing about the shares is, especially rand denominated shares, what they do is they lever the price of gold. So what you have is rand costs, dollar gold price coming in. So in good times, it's fantastic and you probably will make money. But remember, now you're talking about an actual operation that has cost, that has labor, that has what do you call them? All of these things, underground risks and movement of earth and all of that. So there are those complications. Over the long term, you tend to overlook them. But when the gold price is this extended and valuations are this rich, it just takes a little bit of a disappointment somewhere around that chain to hurt you when you hold the stocks. So if it's gold you're interested in, there are some less risky ways where you just go straight into the gold price and hold it that way. But the levered plays, you must be aware, you're dealing with operations here on top of the gold price.
Yeah, well, on that theme of dealing with companies where you're playing a commodity price, but also with operations, Thungela, there's a question here. Thungela, still a nice yield and seems fairly priced to competitors. Have Transnet troubles and global energy demand slowdown been fairly priced in yet? Rowan, do you think that that's all in the price at this moment for Thungela?
Yeah, we have seen Thungela come back quite nicely. I think what's happened is we've seen the coal price a little bit firmer than people had anticipated. So that input price is good. I think, coal's here to stay. You're seeing these global diversified miners quite keen on gold. Glencore investors saying no need to spin off the coal assets. Coal inside Anglo is showing some attraction at these levels. So I think Thungela as a coal play is good. Obviously, Transnet is an issue and remains a risk. I don't think we've seen the sort of latest update from Transnet. They missed their reliability figures. There was a slight improvement in volumes, but that still has a long way to go. But I think, as you say, it probably won't get much worse. I mean, maybe people are taking a lead in saying Eskom is improving. And so where the government focuses and intervenes, we can see an improvement in reliability and delivery. And Transnet is getting a lot of focus. And so I do expect that things will improve, maybe take a little bit longer. It has been a bit disappointing, but that risk, as you say, is in the price. And so there's probably upside overall in the share price and sort of in the operational outlook.
Yeah. Roy, would you also be looking at Thungela as though, it has found a bottom?
So the thing about Thungela is price and volume. So price is the commodity price, which is coal. Exactly like Rowan said, coal is no longer the deep dark problem that it was previously. Yeah. People need energy, coal is available, and they've benefited. Thungela has benefited a lot from European Union energy demand. So that's positive for them. But the volume side is the problem. The fact that they have to go through Transnet to get the volumes out is an issue for them. So it's a balance between those two. We've heard good things about the new Transnet management. Maybe over the next 12 to 18 months, things start improving. And if they do and that coal price holds up, then that's definitely good for this solid dividend play. But just understand coal prices will be volatile over time. It all depends on that European demand or if Chinese demand picks up as well. But I think the biggest bottleneck here is that Transnet story. So yeah, I mean, it's come off very high levels. You're probably at a point where it's bouncing off the bottom.
All right. Let's take a look at a stock that really never seems to reach a bottom, Shoprite. Panel's view on Shoprite, Rowan, it's quite a fave. Can we expect this kind of sentiment for a very long time?
Yeah, so Shoprite's a bellwether stock. It has always been highly rated. So I guess where the rating is very high, there's a lot of prospects already baked into the share price. And I guess as sentiment shifts, what we have seen is sort of pre-election, quite a big sell-off of sort of these big liquid South African counters, which would include Shoprite. And it's sort of just drifted quite a lot lower from its all-time highs. But I think things are actually improving. I mean, what I mentioned load shedding a little bit earlier. And Shoprite certainly has the biggest diesel bill possibly in the country in terms of just having to fire generators and make sure the stores are operational. We've had a very good run of no load shedding for some time. We are seeing reports out of Eskom that the energy availability factor is improving. The preventative maintenance is having a real impact on the reliability of the fleet. Renewables have also filled in a gap as well. So overall, that does bode well from operational expense perspective. The consumer is under a lot of pressure. They are shopping down as a result, moving to house brands where obviously Shoprite is well positioned as well. So I think they will benefit overall, and we could see decent results. I think a little bit of pressure on the top line, but maybe the margins will be a little bit better. And I think if we do get a solid election outcome, we will see foreigners return, and the share can certainly move up from these levels.
Yeah, I mean, Rowan talks about ShopRite being a bellwether, and I mean, for a long time, it seemed priced for perfection, off its highs. Roy, do you think that this could maybe provide an opportunity for investors to nibble?
Look, this stock's done very well. And actually, as a company, they've responded to weakness in their competition in the best way possible. They've managed their margins. They've taken over retail space where it's appeared where their competition has fallen away. And they've basically done the right things all the way through. So first, it will be very difficult for either Pick n Pay or Spar or anybody else to challenge them. They held back on margins when they could actually have been expanding them because they wanted to build up their market share. They've also got other stuff that they're doing in that very mysterious other income line where you have 60/60 and all these other things. So this is a behemoth. This is a big moving machine that's got very solid inertia. Yes, the valuation was stretched, but I think this is the time you take advantage of these companies. I mean, a company like this is probably trading around fairish value. So it's a quality company at a reasonable price. It's well worth looking at. I don't think it's too expensive, and I think the short to medium term potential remains quite solid.
What about Vukile, Rowan? Do you think that it gets enough attention?
Yeah, I think it does get quite a lot of attention. It's one of the better, I guess, REITs in South Africa. It's also diversified somewhat Spanish shopping centers. So it's not entirely reliant on the local market. We've seen resilient Growth Point come under a lot of pressure, very high yields. So that means their rating's quite low, where Vukile's tended to do better. Obviously, they're all highly geared, these REITs, in the high for longer narrative on rates. I think South African rates are going to stay high for a long time. So funding costs have gone up a lot. So it does bite their distributable income significantly. So it's to some extent a rate view, just generally, and bond yields as well for all of the REITs. But Vukile is a quality counter, and I think people prefer it just for the diversification. And it's not one of these sort of too large to move Growth Point's almost too big to sort of easily move the needle on, where Vukile is a little bit more nimble and can make a difference in their portfolio.
All right. But for a lot of these diversified property companies geographically, their main position is in South Africa, and it seems to kind of limit the rand hedge gains that you see. For Vukile, would you say that because of its positioning of where it is in South Africa, do you think maybe its gains could be more than the other diversified property companies, Roy?
So if you think about it, the big focus is on retail and township retail.
Yeah.
So they're nicely positioned in places where there's footfall near the taxi ranks and places like that. So they take advantage of the movement around the informal economy, and they're quite close to the person who would shop. It's nice and convenient. I mean, I was just looking up their distributable income in the previous period. I mean, they're around inflation. Most of these, the industry on average is growing its distributable income by about, I don't know, 3%, give or take.
Yeah.
These guys are better than that. So they're definitely good operators with good positioning. They've done that Castellana in Spain really well. So, yeah, I think it's a solid play. But for REITs, exactly like Rowan says, you have to be very cognizant of where we are in the interest rate cycle. So bond yields are high. These are seen as bond yield equivalents. When bond yields are high, you don't want to be in risk assets. You would rather be straight in the bonds, long-term bonds. So you have to balance your view on that perspective. If you think rates will come down aggressively over the next 12 to 18 months, then this is probably a good entry point, but yeah, there might be some pain.
All right. Okay, I hear your point on that. Well, talking about pain, we have not had that for a while. Load shedding. There's a question here from a person who maybe thinks that load shedding could come back. Which two counters or stocks would benefit and lose one of each per panelist. So just be cognizant of that instruction. Which ones should load shedding stage 4 plus return in winter? So basically a winner and a loser if you do have any. Rowan, you're going, ooh. What are you thinking there?
Yeah, so the interesting thing is the banks did a lot of work in terms of what load shedding was doing to the rand, and what we have seen is the rand strengthened quite significantly recently. And I think what hasn't been mentioned is the lack of load shedding, and that has improved sentiment towards South Africa and in the rand more recently. So if stage 4 load shedding were to return, which I think would be very disappointing for all of us, is the rand would weaken quite significantly. So you'd probably focus on the rand hedges, and it could go back to over 19 to the dollar certainly. So we would probably like Naspers. I mean, it's not related per se to load shedding, but the impact of load shedding on the rand and rand hedges. So that would be an easy one to probably pick.
All right. And maybe obviously we'd see some flight on SA Inc. Quite an interesting take there from Rowan, because I think the first thing that you think of is, counters that, possess that renewable energy factor. How would you be playing this if load shedding returns, Roy?
So there's, if you look through the companies, and especially the ones we've spoken about, ShopRite and the like, that have invested quite significantly, those would benefit if we went back. They've also positioned themselves right now that even without load shedding, they're doing well. But if load shedding came back, they would do well. But I'll tell you, the one that is very, very ignored because of its Nigeria exposure is MTN. So MTN was behind Vodacom considerably, and they invested quite aggressively in the last 1 year in what they call network resilience, which is basically batteries and making sure the network stays up. So if we did go back into that situation, at least MTN wouldn't struggle because they are ready. So I guess you also have to look at the people who've invested, the ones who've directed capital in terms of buying batteries and putting in panels and fixing up their resilience. I think that's how I would look at it.
All right. So you're both looking at resilience, which makes a lot of sense. Well, talking about load shedding, on the other side of the spectrum, electric vehicles. I have limited exposure to EV stocks on my trading platform, but would appreciate the panel's comments. In Li Auto, Xpeng, and NIO versus the big hitters like BYD and Tesla. I don't know how much you gents look at those EV stocks. I guess obviously the most common one being Tesla. Rowan, is this something that's on your radar?
Yeah, the EV stocks that have had a significant impact on equity markets and also on a number of areas for South African investors. The impact on PGM demand is important, so you do have to understand the sector and its prospects. What we have seen, I think, is a significant recalibration of the expected demand for electric vehicles, in that sort of the penetration rates, I think, were expected to be a lot higher than they are turning out to be, particularly in the US and more developed markets. A combination of the costs and really the convenience, the actual utility of the vehicle in terms of their range, ability to refuel them or recharge them on the go, has made them sort of less attractive to consumers than I think markets anticipated. And for that reason, we've seen the likes of Tesla repriced quite significantly. That, combined with the Chinese prowess and the strong competitiveness there, BYD and NIO, very good products at much more affordable prices. So I think it's becoming a lot more mature as an industry, and the prospects are reflecting that. So we would prefer the Chinese players. I think they've got the scale, they've got the sort of access to capital, and they're not expensive. So if you look at BYD or NIO, they look reasonably priced relative to their profitability. Where I think still a huge amount of expectations is in the Tesla price at a forward P of sort of over 50. So that we would look for value. And I think it is still an interesting sector to play because of the recalibration of the share prices.
Well, actually, something that just popped up in my head, I mean, just looking at what you anticipate for the EV sector. Roy, would you actually be going for the actual vehicle makers, or would you rather be going for the companies, for example, the miners, that will be making the components like copper for these electric vehicles?
So that's an interesting take. And I was just thinking, the way we look at companies is bottom up, not thematic. And I think when we talk about EVs as a whole, that's very thematic.
Yeah.
But if I, for a moment, just switched my mind, I would say the first thing that's very clear is from a thematic perspective, what the Chinese government has figured is we'll allow our companies to invest in capacity and export as much and also sell into our market. Remember, the Chinese market is the biggest automotive market in the world. So already, like Rowan says, the winners will be found, the winners from a manufacturing perspective will be found in China, no doubt. Even Elon Musk admitted as much, and that's why he's been talking to the Chinese. So you have to be careful from that perspective. Now, you raise a very interesting point around, do you go broader rather than just the manufacturers? So when we talk about the copper revolution, the people who make the components and stuff, you go all the way now to the mining companies, the diversified miners. And that would be the point where I would say, look at the valuation differentials between BYD and all of that and these miners, and just how focused they are on the renewable space and energy efficiency and all of that. And I think the miners would probably give you some diversification, but you wouldn't be playing the theme directly.
Okay.
That I think is where the balance would be. But I'm not very familiar with the stocks from a numbers perspective, but like I said, I'm very wary of thematic investing. It's always about cash flows. It's always about valuation, I would say.
All right. Well, gents, let's get to your stock picks for today. Rowan, what will it be for you?
I'm staying close to home. We are going with Standard Bank. It's a very well-known local bank. What we have seen is all the banks, the South African banks, coming under pressure. That's partly as a result of uncertainty in the lead up to the national election, and as a result, showing extremely good value. They're very well positioned for the medium term. They have significant operations in Africa, so those are growing very strongly. And the discount rates are very high, but it does look like those profits will become up to 50% of the overall group's profitability. They continue in their current growth. So you've got an African play, and I think a combination of better sentiment towards South African stocks plus better sentiment to emerging market stocks leads to significant flow into the likes of Standard Bank, and the share could appreciate quite nicely in the short to medium term.
All right. Roy, what are you hanging your hat on today?
What a coincidence. I'm picking FirstRand, and for almost some of the opposite reasons of what Rowan was saying. So they've got the highest ROE that's been nicely sustained relative to the other big four banks. They have the lowest African exposure, so all of that currency volatility and all of that risk isn't inherent in them. And in SA, they've actually been growing their lending in a conservative way, but they've been growing the most, but the growth in lending has been conservative, which means that if interest rates do come down, they benefit from all of that. And if interest rates don't come down, they've been lending to a relatively affluent base, which means their earnings are relatively sustainable. So I would say the difference between what Ron is saying and I'm saying is that the EM opportunity definitely exists with Standard Bank. I'm going for the SA quality, higher return business that if foreigners do come back, they'll definitely look at, I think, the banking sector, and these are the two big stocks there that have quite strong earnings potential over the medium term.
Very, very interesting takes there. Thank you so much for your time and for your analysis today, gents. I really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Mutooni from Sanlam Investments and Rowan Williams from Nitrogen Fund Managers. Up next, The Close. Stay with us.